My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today we got another great guest zooming in from Colorado, but originally from Dallas. We've got Bruce Fraser. He's part of Elkhorn Partners, and what Bruce does is kind of interesting, and they focus on distressed situation acquisitions. Now that is a mouthful, Bruce. You're in the multifamily space, but I like that turn of phrase, distressed situation acquisitions. A lot of us who kind of cut our teeth in single family homes, we're going after those kind of deals, distressed deals. But what does that look like? What does that mean for you in the multifamily space?
Yeah, I mean, it's a ton of work doing distress, at least in the first year or two. But it seems like to us that it's a clearer path to money as opposed to buying something that's operating really well already, and you're hoping to add an amenity or something. A lot of these properties we're bringing back online. So generally, they're operationally distressed or property condition distressed. That's historically where we've really played. We've bought properties that are 20-25% occupied with half the units hard down. We've looked at one that was 0% occupied, but we didn't end up moving on. But and fast forward to today, though, we're seeing honestly distress throughout the market, even on the cleaner assets because of the capital stack, and so people got their financing wrong, and they're on floating rate debt, and so now there are a lot of opportunities out there where the banks or the lenders were kind of waiting for the Fed to cut. That was broadly expected, but what I don't think was expected was when the Fed cut, the borrowing rates actually went up, and because they're all based on the Treasury market, and so I think now you have a lot of risk managers stepping in and forcing sales, and we've already made offers on quite a few.
Interesting. So there's actually kind of three categories of distress that I'm hearing there. You've got a property that's just really run down and in bad shape, which is what most of us think of when we think of distress.
Right.
We've got the second category you talked about, which is it's operationally distressed, so it's mismanaged. It hasn't been managed properly, so it's high vacancies, too low rent, et cetera, et cetera. And then the third one is financially distressed due to financing from the past couple of years, and now people are needing to find a solution to their financing woes.
Well summarized.
Yeah.
Well summarized. A lot of the deals that were financially distressed, I think some of the operators fed it out of their pocket for a while to keep it going, to try to buy time. And I think, a lot of those pockets are running dry, and the clock's kind of
it's run
alarm
out
sounding. It's run out.
Yeah. Most. Okay.
They may have already even done a capital call, and so
to
try and go to a second capital call would be untenable for most.
Yeah, that is kind of brutal. It's a brutal situation. So Bruce, what does your portfolio currently look like? What kind of properties, what markets are you guys in? Give us a snapshot of the portfolio today, if you would.
Sure. I mean, we're on the principal side. We're exclusively focused on multifamily in the South and Midwest. Right now, we have a concentration. Even though I live in Dallas most of the year, we don't invest in Dallas. It's just so much competition, so much money chasing those deals that it's hard to get a competitive advantage. So we're very quantitative about our approach, and we select markets unemotionally. It's really just all data driven, and we honed in on Oklahoma City and Tulsa. They're both top 10 markets for us based on that quantitative research. There are other markets we like, but that's where we're heavy right now. And we took management in house a little over 2 years ago, 2.5 years ago. And so we have a team of 50, 60 people if we're including property management. And the level of knowledge and intelligence coming from the team is just tremendous, because every one of those property managers, every one of those maintenance guys have probably worked on 5 or 10 properties in their career. And so we often know more about the properties that brokers bring us than has been disclosed to the broker. And they admit it, but sometimes we know too much, but it makes us probably not buy as many deals, but it also keeps us out of trouble. Nobody likes surprises with finances.
So, Bruce, I think I can guess what the answer is, but I want to hear your version of it. What do you think your secret sauce is that you bring to the table in multifamily that a lot of other operators don't have or struggle with?
Yeah, my background was a hedge fund manager, and so very quantitative. Like I said, we're not emotional about properties that we're buying or markets that we're in, and so we just look at the data and adhere to that. And there have been deals where we just simply couldn't figure out how the buyer was paying what they were paying for it, and some of those deals are now foreclosed. And so it's just sticking to your guns on discipline of underwriting. Don't go use floating rate debt just to make the deal work, and you end up overpaying. We rarely participate in call for offers deals. People ask us where we get our deals, and honest answers, we just pick up the phone. And brokers know us well. They know we're very well capitalized, and know that we do what we say we're going to do. And so if we say we're going to buy something, we buy it. We don't retrade. We don't act surprised when we show up to a C class asset that it's a C class asset. We've underwritten it accordingly, and so I would say that's the secret sauce. That and our team, and just good quality team, and compensating them well. We a lot of you don't go to grad school and say, hey, I want to go get in property management. Usually it's just not a sexy industry, but we have seen other third party property management companies that really just try to minimize expense. And what you find is then you have employees that they could walk out the door tomorrow and replace their income waiting tables, or anything else. And our people, if they're executing well, are getting all kinds of bonuses, and they're probably making double what they could make somewhere else. And so they value that job greatly, and want to keep it and hit those goals. And if they do hit those goals, our partners are making millions of dollars. So
Yeah.
It's worth it.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So, Bruce, it sounds like you've got a fantastic syndication business going. It sounds like you've got a lot of success and track record. A big part of this is raising capital. What do you guys find works best for you, besides word of mouth, obviously, for generating new investor leads for your business these days in 2025?
Yeah, we don't market at all. We have a very limited footprint on social. I have LinkedIn posts that I make periodically. It's never really about real estate. It's just macroeconomic views. And so most of it is word of mouth, and also just talking to good people like you.
Very cool. Very cool. And are you
We've
finding?
had more than one podcast interviewer actually invest with us, and our real estate attorney invests with us, our insurance guy invests with us. They see a lot of people out there, and I think we're differentiated in a lot of ways.
Well, it sounds like you're sweet talking me now, man. I tell you what. Awesome, Bruce. So let's talk a little bit about what you're seeing in the economy right now, especially with these distressed situations when it comes to financing. Have you taken down one of those properties recently? Like with the
Last one we
financial
bought
crisis?
was May. We have open offers out on 3 foreclosures right now, and we'll just have to see. It's a situation where the lender loaned more than we would have paid in total for the property, and
That's what I'm
so
wondering. Yeah,
yeah,
like
they're still adjusting to the thought of taking such a big loss. But again, we know these assets, and one of the lenders contacted us about a couple of them, and they wanted us to make an offer. And I said, listen, you need to send some representatives to see this asset before we make you an offer, so you don't think I'm an asshole. And
mm,
because it's just terrible condition, it's like 10% occupied, and there's a
oh my
burn
goodness.
building, it's a mess. It's fixable. It's in a great part of town. I'd love to fix it. But we know what we could sell it for. We know how much it's going to cost to fix it, and the delta is what we could pay them, and that's what we offered.
Yeah.
But what are we seeing? the whole reason I'm in multifamily is I think it's a great inflation hedge. I think it's one of the best inflation hedges. I've had a negative view on inflation for many, many years. In fact, I published something, I don't know, it was probably 5 years ago now, and it was rather contentious at the time, but now everybody's like, oh, of course that's true. But we're just positioning accordingly, as I say, for our views. And so we expect inflation to be high and sustained, mainly because the U.S. government debt is so out of control that the only way they can overcome that is to inflate their way out. And so we're just positioning along with the same thing they've always done is, inflate, and understate it with CPI. And so, we've done very well over the last handful of years. And because of that, we're trying to lock in our expenses as long term as we can. Even our service agreements and things like that, we'll do multi-year agreements so that the prices don't go up. And you have to be in a market where you have pricing power. One of my peers, I was at a small breakout with probably 15 or 20 of them. And he reads my LinkedIn stuff and he was saying, gosh, I thought this was a great inflation hedge. I'm getting smoked. I'm like, well, the key is to be in a market where you can raise rents and fix your expenses. Like you floated on your expenses with debt, and then you're in Houston where there's no pricing power. And so, sorry.
hard lessons learned. A lot of people are learning some very, very hard lessons.
Yeah, and I think that is the big lesson. It's just don't respond to an offering memorandum just because it looks sexy or hot or because somebody else that bought there. Know why you're buying in that market and why you're buying that particular asset. And so many people are chasing deals just to get a deal. And I would argue that winning a call for offers is not probably really winning because you're bidding against yourself. And that's how we ended up in distress. Cap rates got so low in Dallas because we used to own in Dallas. Just seemed like buying distress. Yeah, it's a lot of work in the first couple of years, but you're not paying a 4 cap for a C asset.
Plus, you've got less competition, right? That's in
a lot less
smaller markets and all that.
Being in secondary markets and having the size that we do is a real competitive advantage for us because all the local banks know us, all the brokers know us.
Well, and having in-house management is huge too. So many other guys are doing third party, and I can only imagine what a pain in the butt that was to start that whole business because that is a whole different kettle of fish. But now
it was something I fought for a long time. But the third party we were with was just doing such a terrible job. We were spending so much time trying to teach them how we needed it done. And we were 75% of the business, to give you an idea. Wow. And they still like, well, that's not our process. I'm like, I don't care what your process is. I'm 75% of your business, and this is what works. So we ended up parting ways. But first year, our revenue was up 30%. So,
wow. That just shows you how inefficient they were. So as we're wrapping up the conversation here, Bruce, what are the big plans for the next 12 to 24 months?
Well, we just added to our team, to help give us a little bit more capacity for underwriting and other analytics just to monitor things in the business. And, when you have as many doors as we do, there's a lot of money being spent and you want to make sure it's being spent prudently. But also on the underwriting, I don't want it to be me to be the critical path delay that, we're wanting to underwrite a deal and I got busy doing something. And so now things can happen when on underwriting when I'm not involved and I just kind of review it, which is great. So we just rebuilt our financial models, making them just really institutionalized, much more complex sounds scary, but it can handle all the situations we've come across the last 15 years and things that we kind of used to have to tweak the old model for. Now it's built for that. And so really quick to underwrite. With that, those two things being said, you can imagine where my head's going. We're planning to expand quite a bit. Back in the hedge fund days, I had a private equity guy that was invested with me, and we had completely sidestepped the financial crisis of 08 and 09. And he told me, hey, if you don't grow your business now, then when will you? And so that kind of still resonates with me. And I look at Elkhorn and how we were positioned coming into what has honestly just destroyed a lot of firms. Most of the firms are having to deal with looking internally and fixing portfolio problems. We're not in that position, thankfully, because we got it right. And so between that, protecting our investors' capital, and we sold a couple of deals recently that exceeded return expectations. While they have other operators that they've invested with that are zeros, and so very thankful investor base. And so I think we're well positioned really scale. I would love to double Elkhorn's size in the next 24 months.
Awesome. Bruce, if people want to connect with you and find out more about you and Elkhorn, where should they go? What should they do?
Yeah, I think probably the best way to learn more about us is my personal LinkedIn. I don't post frequently, and like I said, we will never post publicly about deals, but you can learn more about macroeconomic views and why I believe that translates into you needing to be positioned in real assets. And then you can always connect with me and DM me, and then we can tell you how to get more information about Elkhorn Capital Partners.
There might be more than one Bruce Fraser on LinkedIn. So what's the best way for them to know it's really you?
Well, you could probably provide them a link. I can provide it to you, and then just make sure it says Elkhorn Capital Partners.
There you go. Perfect.
Yeah.
Bruce, thanks for being on the show. This has been great, and thanks for explaining what your version of distressed situation acquisitions are, and the three different things that you guys are looking for these days. It's been great. Thanks for being on the show.
Thanks for having me on. I appreciate it.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.